Welcome, everyone. This is Michael Prestwich. I'm president and founder of ImagiSOFT. Thank you for coming. You can see ImagiSOFT's home screen. If you read the bottom about ImagiSOFT, we've been in business 35 years, and it's thanks to customers like you. Speaking of our customers, we have Trustpilot on our screen. As you can see, the very short review that we got here from Michael Smith. He says he made a sale on the very first time that he used our software. You can read other reviews. Tommy Ruff showed it to some CPAs. Anna Lee Leonard. One that I wanted to point out was Mark. Everybody so far has given us 5-star reviews, but Mark only gave us 3. He says, you know, your report needs a fresh look. In today's technical or tech possibilities, I'd like to see reports have a little more visual crispness. Well, Mark, we listened to you. Clear back in March, we have revamped our Stretch IRA software. We now call it the multi-generational income generating machine, and we have added a presentation to it so that you can explain everything about the concept of how to generate income on one page. And I'll show you that in just a moment. I would like one of the things we do, whether you give us no stars or 5 stars, again, we prefer the 5 stars, is that we accept the Trustpilot recommendations from you, our users. So if you would, just press that icon that says Trustpilot, and then you'll see review the company, and then give us a rating. Again, we like the 5 stars, but be honest. We want you to be honest. If you will voice your opinion, if you will rate ImagiSOFT, we will add 2 months free to your license, regardless of what you show us. Okay, let's go to the multi-generational income generating machine. Here's the page on that. You can get to it by hitting the retirement software, or you can do it on our front page. There's a second way to get to it as well. Here's the 3-minute video that most of you have already seen. Here is a question. This is a great door opener, this software. Ask a grandparent this question. How would you like to convert your current retirement account into an income generating machine that sends you a monthly paycheck for your lifetime, the lifetime of your spouse, and the lifetimes of each child and grandchild? Good conversation starter on the golf course, at a party, whatever. I'm sure you've dealt with retirees enough to know they've got these concerns. We cover all of those in that presentation. Now, some people in the last webinar asked for a sample illustration. You'd get it from this page. You can see it. It's right here. If you click that illustration link, you'll notice that it comes right up with the illustration. And here's your income generating machine. And we're going to get right to that. Another thing you should know, another question that people had in the previous webinar is it approved for sale with securities? Well, it has been FINRA approved. What you need to do is go to your broker-dealer compliance area, and here's a sample report. This one has a different disclaimer than the other one that I'm showing. I'm going to be showing an indexed annuity in our example, but this one shows the disclaimer and has wording for investments, just generic investments. And so that's the one you'd want your broker-dealer to do. So click this sample report, save it, and email it to your compliance officer. And then it has been reviewed by FINRA, as you can see, back in 2009. And that'll help them get it through quicker. And if you want to click what the 6 FINRA concerns are, you can look at that on our website. Let's go right to it. Let's look at the presentation. One of the things that other users have told us is that, Mike, you have all the information in your Stretch IRA software, but it's hard to find. Could you put it all on one page? So we did that. So here is, we came up with this graphic to help Mark and other people's concerns. And I think this is very, very powerful. We've had real good reviews so far. So it's John and Susan. John, your 84-year income generating machine. I'm going to show you how to turn your $1 million from your 401k and have it generate about $4.3 million of total income. As you can see, the machine just starts generating paychecks, and that's the purpose of the income generating machine. To make it work, there's 5 steps. First of all, you have to defer taxes. So your 401k already does that. All qualified accounts defer the taxes, and when you pull the money out, it's taxed there. But if you leave it in, it stays tax deferred. You want to defer that if you want to get the maximum amount of money out there. You want time and compound interest to work. And so here is the time element. You can stretch the time out by doing the required minimum distribution. I'll explain that on another page. But just so you know, it works with time and compound interest. And talking about compound interest, that needs to be a steady return. The steady return means you need to avoid the downs, because if you have, we've had in this century, we've had 2 major downturns where people have lost sometimes 50% or more of their retirement account. If you lose money and you're taking money out, you can destroy the money machine. So what the purpose of the income generating machine that I'm going to be recommending is to continue that income over your lifetime, your wife's lifetime, and the lifetime of your kids. It has to be set up properly. The steady return is one of those. I am illustrating 4.58%, and I'll explain where that comes from in a moment. The third thing we've covered kind of just now, or the fourth thing, and that is account safety. It needs to be safe. You can't have these major downturns disrupting you. And then proper planning. That is a big one. And that's what your 401k is missing right now. If you had this set up the exact same way in a 401k account, as soon as you pass away in 22 years, you're 65 now, I'm assuming that you live till you're age 87, and then you pass away. You would have a problem. You would have, the machine would stop right here. Probably what would happen in your 401k is Robert, your oldest son, would be there at the funeral and say, "Mom, doesn't Dad have a 401k? Yeah. Aren't you the beneficiary? Yeah. Well, you ought to call him and see what you should do." So she calls him up. What happens? "Well, would you like us to send you a check?" Yes. They send her a check, and the machine stops right here. And there's the disastrous tax problems that happen right then, and I'll show you that in a minute. What we want is we want a smooth transition. John passes away, and we don't even have to miss one paycheck. It can just continue right on, the same 4.858%. Susan continues. So he starts with $1 million. He takes $1 million out over 22 years. She inherits the balance of $1.1 million. It continues to generate paychecks, another $1 million to her over the next 12 years. At age 95, she passes away. The machine we want to be able to continue on and have the $754,000 that is Robert and Marlene, Johnny, Bobby, and Susie, each getting their paychecks. In Susie's case, since she's just born, she's only 0, for 50 years, she continues to get a payout. The total of all of those paychecks over 84 years is $4 million. Would you like to know more? That's everything they need to know about the Stretch IRA concept. It's really an income generating machine, and you've got to keep the machine going. All the other pages are supplement to this page. So let's kind of go over this one bit at a time. Now, you can sell different products with this. A lot of our audience sells a product called fixed indexed annuities. And so I've done that on this particular one. Obviously, you can sell any kind of investment that you have there, but you have a fixed indexed annuity, and you need to have a product illustration. Why do I say that? Well, because this is a supplementary illustration. The insurance company you represent should see this. You should submit to their compliance, say, I'm using this concept to sell your product. And then you've got another agency out there that you're very, very aware of right now, and that is the Department of Labor. The Department of Labor wants you, as a fiduciary, to be totally objective in what you show. Fixed indexed annuities have been in the past, a lot of people have used them to be commission generating products. You need to demonstrate that you've done your research. And as you can see, it says that right here. You've based it on your knowledge of the person's risk, their financial goals, financial stability of the insurance carrier, and by comparing historical periods of index strategies recommended. You may want to show more than one. Just to show that you've done your homework. You certainly want to do more than one illustration and keep those in the person's file. Let me show you the most important page that we would have for that. And I've still got all my notes from the last one. So I'll erase those. Okay, this page is part of the NAIC, National Association of Insurance Commissioners. They got together and said these indexed annuities need to be compared so that clients and producers can present them properly. And so they understand what the rates of return are. Nobody knew what the rate of return or the potential return was. So they said you need to compare the strategy that you're doing with the index. And over the last 20 years, you show the most recent 10-year period, the worst 10-year period, and the best 10-year period. And then they have a formula to figure out the interest rate, the compound interest rate. And the most recent 10-year period is 4.58%. That's where I got the number. The worst is 3.3. And I did a second illustration at 3.3. And then the best, if you want to show something that's nearly 6%, you can. I personally like to stay more in the middle. So you can say, the reason I use 4.8, here's the best, here's the worst. This is something in the middle. But I'm also going to show you 3.3. Now, you'll notice down here that this illustration from an insurance company has on it your name, prepared by, and it should not say for trusted or loving client by trusted advisor. It should have your name, and it should have their name, their age. It's got a date on it. Why do you want that? You want that as evidence that you have shown them something. If you're showing the same product to every person, a sample illustration called valued client over and over again, you can be subject to a fine because the Department of Labor will take the tack that you sell the same thing to everybody. You're doing it only for the commission. What's the fine in this case? It's the amount of the rollover, $1 million. I don't think you want to risk your credibility or a $1 million fine by not doing an illustration that has your name on it and a date on it. Insist on that. It also should have your contact information, and that is actually in several states it's required to have your contact information. In California, you have to have your state license number. This page is also useful to explain the strategy. This one has a 45% of the S&P 500 participation. Okay, so here's the index change. It goes up 3%. You get 45% of that, 1.59%. Very, very straightforward. The nice thing, what you're doing with that 45%, the insurance company is protecting you against the downs. Look at this, 38%. If you notice, this started in 2007, so this would be 2008. From January to January, went down 38%. You would get protected. You get 0%. So that's what you're getting from the insurance company, is that downside protection. Remember when we talked about the income machine, you needed a steady return? That's what we're talking about. We're talking about, okay, here you're getting 1.5, not a lot, but it went down, didn't go down. 0, that's better than losing 38%. Oh, next year it rebounded. You got 23, you got 45% of that, and 10%. If we had the index in here, your hypothetical index, going down 38%, it would have used up all the 23. It takes about 50% for 38% to come back. So then 12, then 0, then 13. It isn't until year 6 until the index came back. You'll notice that the account over here earned interest, went from 0 to 10. It's going to be ahead of this 20%. It's still going to be ahead of this. It stays level here, and then it's about even. And of course, the index over a long period of time will generally win. But this is a good strategy to protect yourself. So that's why I chose that product. Okay, let's go back to the illustration. You can see we kept the same front page. But again, make sure that your name is on here. The client's name isn't valued client, Mr. and Mrs. valued client. It's got a date. And then your name and phone number are going to appear on every page. The disclaimer page has been improved so that it will talk about taxes and some other things. So that if you used our software before, we put a lot of thought and energy into that. And then the disclaimers. This particular disclaimer comes if you use a fixed indexed annuity. If you use an investment, there's a different disclaimer. So it differs by product. That's a change. Okay, this page has been updated. Remember, what is the problem with your 401k? The problem with the 401k is there's not an easy transition from the 401k to the wife. And quite often, they won't know better, or even the company that doesn't want to do business with the wife will just say, hey, do you want us to mail you a check? If that happens, she will be saying, here you go, I'll pay $451,000 in taxes in a single year. Well, that'll wipe out any gain that they would have had in that 401k by getting large stock market returns or potential ones. The smooth transition, the steady income is the key to the stretch IRA. And I'll let you read this. You can read these, and it's something you'd explain to the client, especially, when you're in the education. One of the reasons for giving this and having your name on it, they can contact you if they have any questions. If any of the pages get separated, the heirs, the kids, the accountant, they can all see it. A sales concept that goes along with our front page is the Benjamin Franklin's legacy. He left $4,000 and he wanted it left for 200 years. So in 1990, the 200 years were up, and it had grown to $1.5 million. But if you do a compound return on that, it's only 3%. What did he do? He understood time and compound interest and also safety. For you to get your return, You've had your growth phase. You've taken the risk. Now you got your $1 million. You want to keep that $1 million intact. You can't have a 38% drop and drop it down to 600,000. It'd take 5 or 6 years to come back. It'll just disrupt the whole machine. You also want it to be easy. You want it to be managed so that your wife, when you're gone, doesn't have to mess with a bunch of different investments. Now, I'm not saying investments are bad, because a good investment advisor is something that you need as well. And if you have the right investment advisor, yes, as long as that person is helping you, you can take care of that. So just make a good investment advisor or insurance agent will provide a proper custodial agreement. Now, how do you make it work? And you can read that and read it to your client. But the basic steps are: name your beneficiaries. They have to have their own name on it. So Robert needs his name on it. Marlene needs her name on it. The grandkids, little Susie, is going to be her given name. Her social security number. Make sure she's absolutely designated. You withdraw at least the RMD. It tells you how to calculate it. And here's the steps on doing that. Here is the disclaimer. This is the second place that the disclaimer is in here. Then these little bullet points here address the FINRA. If you check that FINRA box on our website, it talks about all these little things. These are things that can change the 400 or the $4 million. You might not get that. There might be an estate tax that comes and goes. As you know, they're talking about changing the income taxes. If there's a change in the tax laws, it's all going to change. But the main thing is put the machine together and let it go through time, just like Benjamin Franklin did. You know, when he set up that trust in 1790, there wasn't even a United States yet. There wasn't even a dollar yet. He was doing it in British pounds. I mean, he went through political turmoil. You'll do the same thing. Go with a safe institution that's going to outlast you and your wife and your kids. Okay, there's the assumptions. You can change this, the interest rates for each kid. You can give them all different percentages. And then you've got the ledgers. So John, we're just assuming that you're doing just the required minimum distribution. What if you want to start early? Yes, you can take out something more than that. You can, and that would appear right here. So if you wanted to start with $48,000 a year, this would be zero. They'd have $48,000 and have the money machine start sending you $4,000 a month because you're age 65 and you're retired. That would change the numbers, and I'll rerun that illustration for you. But you have the same concept. And then once you hit the 49,000, the 48 with the elective withdrawal would go to zero again, and then these higher numbers would go. One of the things I like about this is you're getting a modest increase, similar to like an inflation increase, because the life expectancy, that number goes lower, and you divide the account balance by that lower number, which gives you a higher payout. Then when you pass away, Susan takes an IRA rollover. She's got, in this case, $1 million or 1.1 million. She continues the same strategy. And then you can read the extending your legacy. This is important for you to know as an advisor. She becomes the current IRA rollover or owner when she does the rollover, which means she can change the beneficiaries. If you want your kids, let's say you are, this person, John, was married before, and maybe Robert was from the first wife, and he wanted to make sure Robert was going to get something. The way to do that would be to have multiple IRA accounts with Robert as the sole beneficiary to do that. So just remember, that's a tricky situation that can happen. Here's Robert. And you see how his divides out. And it just goes on with Marlene and Johnny and Bobby and finally little Susie. So there's the 5 beneficiaries. You see where she gets her money. And then there's this disclaimer here that talks about the taxes she'd have to pay. And you can go back to page 4 and see how that taxation, that's the one with Uncle Sam on it. And the same thing with this hypothetical return. See page 8 that has that disclaimer on the tax. And that's basically what you've got. You've got something that is compliant, that has gone through FINRA, something that has simple, that has the presentation on it right here, where you can go right through all of the pieces. And then if you want to get into more detail, it has the details. But again, you'll know by the time you get done with this page here whether or not they like the concept. I don't know if you saw the little chat, but there's a little bubble right up here at the top, and you can click that bubble. If you have a question, now would be a good time to ask that. If you don't, I'll just go on. Okay, I don't see any questions coming up, so I'm going to move on. So back to our website. How do you use the software? As you can see, it's $400 per year, and many of you have already purchased the software. The Windows software that we have we left that the same. This is an upgrade. It's web-based. Anybody who bought the Windows software in the past has a login for the Windows. Mike McGovern has been very good about getting everybody in there. And so from any screen, it's right here. It's called the login. And it'll take you to this one. I've saved my username and password. The username is almost always your email address. And the password is 123456. And so you obviously want to change that. So when you first come in, do the edit my information. We don't know you're doing business as, and the business address and the phone number that you want to be contacted with, and the email account that you want necessarily. You might have several. So you change those, but for sure go in here and do the password change. We do not know your password. We don't want to know your password. You change your own password. If you forget your password, we don't have a reset thing. You just call our toll-free number, talk to Mike, and he'll go in and rechange the password to 123456. And then you press next to save it. Then we have a number of products. We're doing the Stretch IRA product. And you press next. Here's the storage tab. As you can see, I've stored the one that has the total income here is the one that has the 4.58% return. This one here is the 3.3% return. You can do multiple illustrations on your client. I think it's good, as I showed you on that page from the insurance company, show the worst 10 years in the last 20 and show the last. If you want to show the best, you could do 3 and just kind of give them an idea that those are some of the variables that make this thing change. Press the next key and it'll retrieve that. So as you can see, I entered John J. Sample, male. I put in his date of birth, calculates his age, gave him an assumed age of death that's maybe 2 or 3 years beyond the normal life expectancy for a 65-year-old. You can either press the next button down here and go to the beneficiaries, or you could have pressed the tab right there. The spouse beneficiary, you check that box if they're single and there is no spouse, or if the spouse is not going to inherit, then you don't click that, and it goes, all this disappears and goes gray. And then you put in the hypothetical rate of return. As I mentioned earlier, it can be different per person. And the assumed age of death, 95. Ultimate beneficiaries are the people who are going to inherit after the spouse dies. There's 5 of them. So I went through and entered Robert, rate of return, and the percentage. He gets 12.5. They need to add up to 100%. So as you can see, Marlene gets 12.5, and Johnny gets 25, Bobby gets 25, Susie gets 25. That adds up to 100. So you can press the next key. And then here's your account type. You can do a traditional IRA, a Roth IRA, a non-qualified annuity, and then you can do fixed indexed annuity. So if you wanted to show an investment portfolio like I did earlier, you'll get, if the main difference there is a different disclaimer. You'll have a different disclaimer with a variable annuity and a traditional fixed annuity. I'll just keep that one. And this is how you do those withdrawals. Remember, I mentioned you could do $48,000 a year. If I wanted to change that to $48,000, starting now at age 65, all the way through the end, I can do that. So I'll go ahead and do that. Press the next. You can look at the graphs, but the main thing you want is the preview and see the report. And so what does that do? If I take out money early, instead of 4.3 million, it's 3.4. But it's fine being a lesser number because that's what he wants it to do. He wants that money early, and he wants it more for him than he does for his kids. So you tailor this around the person. And you can use it to compare versus income riders, for example. You could show an income rider, guaranteed lifetime income rider, and you could show this. And as you can see, here's those elective withdrawals that I was saying. Here's the 48,000. And then at this point, starting at age 78, the RMD is higher than the 48,000. Anybody have any questions? Go into the chat. Okay, that's basically what I wanted to show you, is that you have the power on the web. You can all do everything from ImagiSOFT's website. If you want to go back to the website, you can just click the quick menu. Just click back and you'll get right back to the main screen. Remember the Trustpilot? Click this link here and you'll get 2 free months added to your subscription. It's $400 a year for the Stretch IRA. I don't know how much Michael Smith did here, but I do know if you go down and read here's Jeff Henson. Read what he says when he says separate yourself from the masses. He was working with one that was 900 and something thousand. No, it was 1.2 million. It's a $1.2 million sale. And he got it solely because of this concept. He competed with a insurance agent with the exact same product that they had seen before, but because he knew about this concept and presented it in this way, he was the one that got the sale. If you have any other questions, you know, send them to Mike McGovern, email us. At the bottom of every page, you have our contact information. You can do tech.support@imagisoft.com. I will see that. Mike will see that. Our programming staff will see that. You can read our privacy policy if you want. But, you know, for most people, the best way to call is just give us a call on that number and talk to us. Thank you very much for attending. We appreciate your business. It looks like I've got... oh, okay, that was from Michael McGovern. He just said, if you want a sample report, Mike has several different kinds and one for every one of our products. Earlier today, I showed the difference between a Roth IRA, and if you want to see that, I can do that real quick. I'll just do that exact same one, but instead of being a go to the account, change it to a Roth, and then do preview. And he wanted somebody wanted information about our Roth IRA conversion software. But the nice thing about a Roth is the RMD is 0. So let's look at that. Let's zoom in there. You notice he gets 0, and then his wife gets 0. And so we are able to go for 22 plus 12, 40, 34 years, and the kids all divide an inheritance of $4.5 million. And that, then they continue to stretch it, the oldest one for 18 years, the youngest one for 50 years, and that's where you end up with $13 million. The difference, and that's tax-free money. The difference is the RMD makes a huge difference. So some people are thinking about our Roth conversion software, and they're all waiting with bated breath to see what the Republicans will come up with the tax cuts, to see whether or not the Roth still makes sense, or if they aren't going to really help the people who have money do that. So any other questions, chat at me now. Otherwise, just give us a call. Thank you very much for attending.